Hello, 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 everyone. I pray all is well with you. If this is your first time clicking on one of my videos, I want to say thank you first and foremost. Appreciate you being here. Today, we are diving a little bit deep. My name is Kobe Courtney Boone. I am the managing director and founder of Boone Capital. We are a private equity firm, Reg D, underneath 506C, for real assets. So think land, timber, agriculture, recreation, all the wonderful things that take place with the outdoors. So today we're going to talk about mitigation banking, and this is one of one of the most intensive, if you will, videos that I've done thus far. It can be a world that is both rewarding. Let me say that. Financially rewarding as well as ecologically rewarding, um, but also one of the most exciting and, dare I say, complex worlds to navigate because of the different agencies that are a part of mitigation banking. So, what I'm going to do is really take my time today and prayerfully leave you guys with a very great synopsis of what mitigation banking is, its history, why it got started, who are the players, how do I get into it, why does it matter, and whether you're an LP currently, whether you're a family office or RIA or other institutional group that is watching this video, or just a new investor, right? I hope that this video today kind of pulls things together in a way that you can understand it, that is digestible, and starts you on the path of learning, if you will, in this particular space. So, what I want to do is back up and make sure we got a little bit of history. And for that history, now I want to kind of read some of that for you guys today. Just a minute. We're live. This is live video. So let's start here. Why mitigation banking was created and what is it? So it's important to start and understand that mitigation banking, it's still fairly a new space, if you will, for folks who are entering into the conservation world, if you will. Still rapidly growing. However, it wasn't created to generate investment opportunities initially. It was created to solve a problem. After the passage of the Clean Water Act, regulators increasingly require developers to compensate for impacts to wetlands and streams. So first reference point right there, Clean Water Act. Developers were um, incentivized, if you will, but increasingly required, if you want to say it that way, to compensate for impacts to wetlands and streams. The early model was called permittee responsible mitigation. In simple terms, what that meant is that the developer would impact, if the developer impacted a wetland and was found that they should be responsible, then they should be a part of creating, restoring, or enhancing another wetland to offset that loss. On paper, it sounded reasonable, right? In reality, results were kind of mixed. Many projects were small, many lacked long term management, and some failed to achieve the ecological functions that they were designed to actually replace in the first place. So, monitoring thousands of individual mitigation sites across the country became difficult and expensive, right? As regulators evaluated outcomes, a pattern kind of started to emerge, and that is that larger restoration projects managed by specialized operators, consultants, whatever the case may be, often produce better ecological results than hundreds of isolated projects scattered across the landscape. It wasn't a one size fits all, if you will. That realization became one of the foundations of mitigation banking. And instead of requiring every developer to become a wetland restoration expert, mitigation banks could restore, enhance, preserve, even, and manage larger ecological systems in advance of impacts occurring elsewhere, again, offsite. Developers gained a more predictable permitting pathway in doing this. Regulators gain more consistent environmental outcomes. In other words, you could say that mitigation banking wasn't created because investors wanted a new asset class. It was created because regulators were searching for a more effective way to replace lost ecological function, if you will. And then the market kind of came after the fact later. So one thing that I'll go ahead and preface here is we've already discussed the Clean Water Act. So do your own research on the Clean Water Act. And that system that is utilized is called the Ribbit system. You can visit that website, RIBITS, Ribbit's website, where you can look up all the different banks, both past and new as well, that are coming online. You can go and actually look up these particular sites. But and in so many words, let's dive into today's video, which is mitigation banking explained like you are a PE, private equity investor. If I told you there was an asset class where biologists, hydrologists, environmental engineers, regulators, attorneys, developers, and investors all had to agree before a transaction could occur, yes, you'd probably assume I was talking about some obscure government program, if you will. When in reality, I'm talking about one of the most fascinating and misunderstood markets in American land ownership, and that is mitigation banking. And if you've never heard of it before, my goal today is to help you be able to understand this a little bit more. Most investors haven't, and most landowners haven't. And as I found it, even some developers don't fully understand how it actually works or how it could be beneficial in their favor, right? So, yet billions of dollars in economic activity depend on it every year. Your roads, your DOT, Department of Transportation, master plan communities, industrial facilities, pipelines, ports, energy infrastructure, data centers, airports. At some point, all these folks have, in some way or another, encountered something that slows everything down. And that thing, most typically, is nature, specifically wetlands, streams, and other environmentally sensitive resources that are regulated under federal and state law. And that's where mitigation banking enters the conversation. What's fascinating to me is that mitigation banking, it may be one of the clearest examples of capital markets, environmental science, and public policy, if you will, as it pertains to land ownership, kind of colliding in a single asset class. And this isn't simply conservation. Again, it's important that I make sure you know it isn't simply conservation and it isn't simply development. It's both. And that's why with the sophisticated investors that I'm speaking with and institutions, and I bring this up, on some of their properties that they're currently holding as an avenue for them. They've quietly, I would say, started to begin paying more attention to it. As I think better education, I would say shout out to the Nature Conservancy and other groups that are out there really advocating and explaining this process a bit more as they're starting to understand these different avenues and layers of the properties that they're holding, and what those opportunities and layers could actually present. So let's start with a fundamental challenge, if you will. Imagine a developer wants to build a project. Maybe it's a residential subdivision outside of Dallas. Could be a logistics facility, highway expansion, whatever the case may be. Could even be a data center. The project creates jobs. So that creates tax revenue. It also creates economic activity. But the project in and of itself impacts wetlands, could be streams that are protected, again, underneath environmental regulations. Under Section 404 of the Clean Water Act, many of these impacts require permits. One of the primary federal agencies involved in this process that you're going to hear me talk about in this video and future videos is the U.S. Army Corps of Engineers. Now, the Corps isn't necessarily trying to stop the development, and I think that's important for developers to understand. And I get it. That's the world that they come from. The Corps isn't trying to stop the development. That's a misconception. The objective is to balance economic growth, again, economic growth, with environmental protection. And that balance, if you will, is what requires mitigation. And you can say this in so many words of saying if the environmental impacts occur, the goal of the regulators is that those impacts are appropriately offset, if you will. So for decades, regulators they faced a reoccurring problem. As I said before, development continued, communities expanded, infrastructure grew, but the wetlands and the streams being impacted along the way weren't properly being offset. So the original solution seemed straightforward in that if a developer impacted a wetland, they could simply restore or create another wetland somewhere else. Simple, right? At least in theory. We're talking about nature. We're talking about real assets world here. In practice, many of those projects can continue to struggle, as I mentioned before. And the monitoring of these thousands of small mitigation sites begin to become more and more difficult, if you will. So the question came up that I would say fundamentally changed this industry, and that instead of every developer becoming an amateur ecologist, as I mentioned before, there need to be a more robust system that would provide the rigorous scientific oversight that was actually needed for improvement of these properties. So, thus, you have mitigation banking that emerged as a market-based solution to an environmental challenge. Super important statement there. Mitigation banking emerged as a market based solution, buying and selling of credits based solution to environmental challenges. Now, here's where things kind of get interesting in this. When most people hear the word bank, they think finance. But when mitigation banks are built, they're built on science first. So before a single credit is approved, and there is a approval process, scientists evaluate hydrology, soils, uh, watershed dynamics, vegetation, stream function, habitat quality, ecological lift. That value isn't per se being created on a spreadsheet. The value is being created by the ecological improvement that's going to occur on that property. And the money, the finance, if you will, follows the science. Your capital is following your science. Not the other way, as we typically see. So that's one of the reasons this asset class kind of fascinates me. Is something that I'm highly interested in, and I make sure that it's on the table anytime I'm talking to whether it's a private landowner, 200 acres last week that was referred to me being inherited by someone, or it's someone doing a development on a 400-acre tract. This should be a part of the conversation for sure. So biologists, hydrologists, again, engineers, developers, investors, all these folks, um, they all have to agree that value was actually created. And I think that's kind of the part that I think is important when we're talking about the regulators and the people who play in this area. There aren't many markets where that happens, so that's the challenge is how do we kind of align these interests, if you will, with these multiple seats at very different tables sometimes to understand the need of kind of bringing that tying it all together. So let's talk a little bit about credits. This is where investors get confused. A mitigation credit represents ecological value created through restoration enhancement. The establishment of that bank, if you will, and the preservation activities that are taking place on that property, that ecological lift, as we talked about before. Think of it as a quantified environmental improvement. So when a developer impacts a permanent wetland or stream, regulators may require the purchase of credits from an approved mitigation bank. Now, the developer receives a predictable permitting solution. Hey, this is the impact that you guys are going to do. We get it. We understand it. It has to be offset. And there's a need for mitigation here. This is the bank that's within your watershed, which is important to know the different watersheds. Typically, if you're going to offset it, that impact is going to be within that same watershed, if you will, where the impact occurred. And the bank receives revenue. The mitigation bank, you buy the credit, receives revenue. Now, the ecosystem receives restoration and protection as a result of that purchase credit, and regulators receive a more reliable approach to environmental outcome. And in that particular scenario, everyone's incentives have then become aligned. Now, if all that sounds theoretical, then let's look at theoretically accurate, if you will. You guys with me so far and not bored out your eyes. Let's look at a real example. So I actually went and pulled this up off of Ribbit's website. So uh, let's talk about regulatory in Luffy and bank information tracking system. So that is again, when I mentioned Ribbits, this is off of their website where you can find these different banks. So it's one of the primary databases, if you will, where regulators, industry participants, and everyone kind of comes together across the United States to see what's happening in this space. So one that I came across was Big Woods on the Trinity Mitigation Bank here in Texas, which is over 423 acres. It was approved through the Fort Worth District of U.S. Army Corps of Engineers. It's operating as a private commercial mitigation bank, and what kind of caught my attention with this one wasn't the acreage at 423 acres. It was the ledger, because once you look at the ledger, you realize that this isn't just environmental science, it's actually a marketplace. So phase one credits have already been released, um, got released, sold. Your phase two credits have now been released, and actually it's nearly sold out at this time. So what are we seeing here? We see that there is inventory, there are credits, there is a demand for those credits for development that's happening. Obviously, in that area, Dallas, Texas Triangle growing, and there's transactions, right? But there's also scarcity, and there's a regulatory framework that is governing this system of buying and selling of these credits. So, in other words, ecological function is being measured, it's being approved, it's being tracked, and it's being exchanged inside a structured, um, governmental, if you will, website and marketplace. And that's a completely different way to think about land. I think the way that most people think about it. So, what am I saying today? If you're a private equity investor, institution, whatever the case may be, this should actually sound quite familiar. Acquire an asset, improve the asset, create measurable value, release inventory, sell the inventory, manage the risk, generate returns, and the mechanics may be different, but the underlying logic is surprisingly familiar for most folks that actually start to get into this. And the difference is that the value being created isn't a building, it's a functioning ecosystem that you can see, touch, feel, um, with biological and ecological impact. So I would say another thing most people don't realize is that credits aren't universally interchangeable. A wetland credit generated in one watershed may not be usable somewhere else. Mitigation banks operate with designated service areas, as I mentioned before. It's typically watersheds, river basins. So geography matters, hydrology matters, ecology matters as well. There's biodiversity, bio, biodiverse banking as well. The environmental value has to remain connected to the natural system that it's actually designed to support. So I told y'all today we were going deep. I might actually lose my voice on this one. So this isn't like moving again dollars between bank accounts. Nature has geography, watersheds matter, and that's one of the reasons these markets become so specialized, if you will. So, from an investor's perspective, one of the most interesting features is how credits are released. A mitigation bank doesn't typically receive all of its credits on day one. So credits are often released over time, as I kind of mentioned about that bank earlier, as performance milestones are achieved. Construction completion, hydrologic success, vegetation establishment, monitoring of benchmarks, long-term stewardship obligations. That's a big one as well. Um, and it should, right? If that sounds familiar to you, all those things it should, because it isn't completely different from what we do in private equity value creation as a plan or at scale. Capital is deployed, asset is improved, performance is measured, value is unlocked over time. The mechanics are different, but the logic is again very similar. So let's talk about your risk. We always have to talk about our risk, right? So because every investment has one, it's no different in the mitigation banking world. First things first, off the bat, you got to get the bank approved, right? There is some investment in cost and going into the initial parts of getting the approval. It's a packet that you have to get approved for setting up a mitigation bank. And to be transparent, these can take, depending on your watershed, depending on your region, your folks that you're working with, if you hire a consultant or not, this is something that could take 7 months, could take 7 years. Just depends. Um, there's regulatory risk. There's scientific risk. We're talking about the government here, guys. There's execution risk. There's market demand risk. I've heard the stories. You know, you can have a bank. It's one thing to set up a bank and go through the permitting processes, but can you sell those credits? I have a team that I work with for these type of things that are of interest out of Florida that have done. Mr. Jonathan, I think, has done has set up 8 mitigation banks. Just done a phenomenal job over 30 years in the space, a true biologist scientist, and having someone that understands how to navigate both sides of the coin, if you would. They've been very wildly successful on the development side, but also actually have set up and gotten these properties permitted for banks. It's a huge asset, and I'm so grateful for his friendship. Um, but there's also timing risk. That is something to think about in this space as well. A restoration project can take years, as I said, before credits even become available. Permitting can be complex. Environmental performance has to be achieved, and long-term management obligations do remain. The management of that property oftentimes are perpetuity. So this isn't passive investing. This is highly specialized land development operating at an intersection of ecology, regulation, and capital allocation as well. And that's why expertise, as I mentioned, Mr. Jonathan Napier, so quick shout out to him, and other folks who have had decades in this space, are who I lean to when it comes to these things as well. So, what's remarkable about this, as I mentioned, is how little attention this receives relative to its economic importance. Every year, billions of dollars in residential development, transportation infrastructure, industrial expansion, energy projects, and public works depend on environmental permitting. And environmental permitting often depends on mitigation. So, in so many words, an enormous amount of economic activity is indirectly connected to healthy wetlands and streams, but most people never see that relationship. But it's there all the while, hidden beneath the highways, the neighborhoods, your huge subdivisions, master plan communities, data centers, whatever the case may be. The environmental market operates quietly in the background while the visible economy, your buildings, your parks, whatever the case may be, they pretty much get built above it. I had a video last week that I recorded where I talked about how this conversation about data centers right now is less of a conversation as people know it about data centers themselves, and it's more of an energy discussion. It's an energy, real asset, and infrastructure discussion. Check that video out. It's a really great one. But to keep moving on here, when most people hear conservation, they think expense. Most people hear wetlands, they think restrictions. What mitigation banking demonstrates is something that's far more interesting, which is under the right circumstances, ecological restoration itself can become the asset. Let me read that again. Under the right circumstances, ecological restoration itself, by itself, can become an asset. So ecological restoration Becoming the asset in that case is something totally different. Not the land after it's developed, not the land after it's subdivided, not the land after it's been paid over. The restoration piece itself. It's a game changer. That's a profound shift in how we think about value creation, right? And it's where the conversation becomes larger than mitigation banking itself. Because the reason I find mitigation banking so fascinating isn't because it's about the wetlands themselves. It's because it challenges how we think about value creation, how we think about value. What most investors are trained to believe that I've found is that value comes from extraction. Build something, sell something, develop something, produce something. Mitigation banking introduces a different idea. And I would say it's as much so an idea of stewardship, which is near and dear to my heart personally, and how I look at assets and how I steward even the own land that me and my wife own, which is that sometimes value is created through what you restore. It's what we steward, what we manage, and sometimes that value is created by improving a system rather than consuming it. Um, a Here at Boone Capital, I think this is important to kind of share, and I'll tie up this video. I didn't want it to be too long, but one of the questions we're constantly asking is, how many ways can a piece of land create value, either through agriculture, recreation, conservation, water, habitat, infrastructure, mitigation, whatever the case might be. And the most interesting properties that I've found often sit at the intersection of multiple opportunities. And mitigation banking may be one of the more sophisticated examples of that principle in action. I believe we're entering into an era where water, habitat, ecological function, conservation, and natural systems are increasingly becoming recognized as economic assets. And that is not instead of traditional development. It's actually happening alongside it. Think about the last time you went to a river and maybe you were visiting a city or Tennessee or somewhere, and or maybe you went running on a trail and you saw a small sign that talked about that water basin or that watershed, whatever the case may be in that area. And there's development, there's park, there's sidewalks, there's concrete, right? But there is a stream that's maybe running through there. Oftentimes, if you look hard enough, you'll find that that's a part of either some mitigation play, some conservation play, or whatever the case may be for that development. There's some protections that are in place there. So they're kind of happening and coinciding in and of themselves, where we're not intentionally disturbing and creating ecological disruption or impact, but we're building, again, in a way alongside it. How can we allow this nature component to actually enhance this development, if you will? So again, growth still matters. Infrastructure still matters. Housing still matters. It's definitely a need, and I understand that need as well as both a landlord and the challenges that are faced by renters today as well in properties. So again, I think it's crucially a conversation around stewardship, and mitigation banking sits at this perfect intersection. So um, land generates income because it stays protected. Other land generates, let me say it back. Some land generates income because something gets built, whereas other land can actually generate income because it gets protected. And as you go along this education and this learning around these opportunities on your properties or that you're looking at, um, understanding that distinction may become one of the most valuable perspectives that a land investor can develop over the next 20 years, especially as we're having more and more discussions around water. So, in so many words, that's mitigation banking. And I think we're only beginning to understand its long term significance, if you will. So I hope this video was not too boring to you guys today. I wanted to really take my time, have my notes that I was able to pull up for you guys today, and give you guys some solid references to go back and just have some more education on this space, because it is something that is complex, and there's so many folks I can shout out. Again, Jonathan Napier, Ed Stanton out of Florida, with Equity Land Partners, have been absolutely amazing to me along my journey with starting my firm in Boone Capital. Wildlands Engineering. Again, I'm not getting endorsed by any of these. These are just people that I personally have found valuable. Wildlands Engineering in Charlotte, North Carolina, have been super helpful with the mitigation banks. Um, and just the history of the area up here in Charlotte, North Carolina. I'll also share with you guys a couple of references here. So you can look up the U.S. Army Corps of Engineers Regulatory Program. We talked today about the EPA Clean Water Act, specifically Section 404, um, Interagency Review Team. So IRT, as it's referred to, is the Mitigation Banking Guidance, if you will. So IRT, um, Federal Mitigation Rule from 2008, Society of Wetland Scientists, Ecological Restoration Journal. I want to reference them. They were a part of this video today. As far as my research, National Mitigation Banking Association, U.S. Fish and Wildlife Service is involved, Texas Mitigation Banking Interagency Review Team. As I spoke about Big Woods and that bank, that 423-acre bank earlier today, and then the Environmental Law Institute Mitigation Banking Reports is a great resource as well. So you can go and look these guys up, do a quick Google, Chat GPT, whatever you're using, and find out more. If you're interested in this type of stuff, if this video was helpful for you today, feel free to leave a comment below, or if I said something that was kind of interesting to you, but you have more questions, you can feel free to email me at kobe@boonecapital.co. Kobe@boonecapital.co. We are excited. We are currently evaluating a property in Dallas, Texas. That was a former sand and gravel quarry mine. So billions of water. One of the particular lakes, there's four major lakes on this property. One is 55 acres, and we estimate now in pre-due diligence that it's over 200 feet in depth. So pretty excited about what we'll be able to do potentially with this property. But if you're interested, feel free to schedule a call, get in contact with me. We'd love to speak with you. But until next time, God bless.